I work with individuals in their 30s and 40s who are very well compensated, and often the topic of early retirement comes up. These individuals have great careers that have allowed them to save a good portion of their income, but often they have very stressful jobs, and the thought of retiring in their early or mid 50s is very appealing to them. What is unclear, though, is the best way to prepare for and navigate an early retirement. Many think there's a trade off between tax savings now and access to funds in retirement when they're planning. They have questions on whether they're saving enough and whether they're doing enough to hit their other goals, like saving for their kids' education or buying that second house to take vacations with their family. So today I'm going to go over the blueprint for those of you in your 30s and 40s who are considering an early retirement. And before we get started today, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. And often when I meet with my clients for the very first time as prospects, early retirement comes up, specifically retiring somewhere in their 50s. And often these individuals make over $500,000 a year and want to make sure they're doing enough to retire when they want. So when I meet people for the first time, I often go through different steps they should be taking to make sure they're on track and then talk to them about what early retirement looks like for them. I call this the early retirement blueprint. And there's 3 steps to the early retirement blueprint: saving efficiently now, goal setting, and then distributions in retirement. So let's dive into saving efficiently right now. The next few minutes will be a brief overview of things you can be doing in your 30s and 40s to set yourself up for a successful early retirement. And if you want more details, I would suggest starting with my video on how high-earning W-2 employees maximize their finances before finishing this video. So assuming you find yourself in a higher tax bracket right now, it makes sense to take advantage of tax-friendly accounts, something like your 401k or your 403b at work, and contributing up to the annual contribution limit of $23,500 for 2025 will help you save on current taxes. And then we can convert these to Roth dollars in retirement, and contributing up to the annual contribution limit of $23,500 for 2025 will help you save on current taxes. And then we can convert these to Roth dollars in retirement and spread this out over the lower tax brackets than what you're currently in. If you have the opportunity to do a mega backdoor Roth conversion within your employer plan, this is a great way to get tax-free growth and tax-free income in retirement. While this doesn't offer upfront tax advantages, this will be a huge tax savings in retirement. If you don't have the option within your 401k, then taking advantage of backdoor IRA conversions for you and your spouse is the next best alternative. Something else you should be taking advantage of if you have a high deductible health insurance plan is an HSA. This provides upfront tax savings, and this money can be used tax-free for qualified health expenses regardless of your age. The funds can also be invested to grow, which is a fantastic way to increase your chances for paying for health insurance or health-related events in future years tax-free. Any extra funds that you have left over after that should be funneled towards a taxable brokerage account. This is ultimately going to be the first source of income that we tap in retirement because you're not subject to the other early retirement restrictions or the early penalties that you would take for taking money out of a 401k or an IRA early. This is essentially money that you can pull on at any point in time to pay for your expenses. So for somebody who retires at 50, this becomes very important because you're not going to have that huge burden of paying taxes and penalties because you're taking it out 10 years too early. We just covered what is likely the most efficient way to save for early retirement, but we left out something very important: planning for other goals that may take precedent over saving in the most optimal way possible. Often when I am working with a new client who wants to retire early, they have kids, and it is important for them to pay for all or part of their kids' education. They also might have other goals such as buying a second home, upgrading their current house, or looking to invest in a cash flowing business that can generate income for them in early retirement. This is why it's so important to talk about the optimal way first, because then we can work backwards and find the most optimal solution tailored to a specific client. This will take into account not only the best possible way to save, but their goals to make sure that they're going to hit those along the way as well. So let's go over a brief example as to what I'm talking about. So let's take, for example, a married couple who's 35 years old. They live in New York. They make $600,000 a year and they have 2 kids and they want to retire in 20 years at the age of 55. So in their age 35 year, they're going to give $46,000 to retirement accounts. They're going to give $8,300 to their HSA because they're covered by a high deductible health insurance plan. They're going to pay roughly $45,000 in New York state tax and about $120,000 in federal tax. This is going to leave them with take-home pay of about $380,000. So before they account for any other expenses, they're basically bringing in from their paychecks $380,000 after we account for everything that we just went over. And let's assume that they spend $20,000 a month. So they will have about $140,000 left over. So from the $140,000 they have left over after accounting for all of their deductions, that's what they're going to have in discretionary income. So let's assume that they also want to fund their kids at college education. Let's also assume they want to buy a rental property within the next 10 years for cash of $500,000. So these would be their goals that will take precedent over the most optimal way to save. So we got to build these into their plan somehow. So let's go over a breakdown in order of importance, how they should allocate those remaining dollars to maximize their chances of early retirement while also hitting those goals. And before we get to the example, I would really appreciate it if you hit the subscribe button below. This lets me know that you like this type of content and will help YouTube get this video to other people who are interested in it as well. It also lets me know what videos to make for you in the future to keep you engaged and happy with the channel. All right, so we know that our couple who's considering early retirement has $140,000 of income left over after they pay their taxes and all of their other expenses. So the first thing they should do is they should consider maxing out their IRAs for the year. So we're going to assume that they don't have the backdoor Roth option within their 401k plans. So what they'll do is they'll each make a $7,000 non-deductible contribution to a traditional IRA and immediately convert it to Roth dollars, assuming they're not subject to the pro rata rule. And that'll be money that's used for retirement for them somewhere down the line. The next thing they should do should take their nearest goal into consideration first, which is funding their kids' college education. Let's assume that we've done the math and we know that they need to do a $15,000 a year contribution for both their oldest and their youngest child in order to properly fully fund their college education. So for their oldest child, they need to make the $15,000 contribution each year for the next 7 years to fully fund their education expense. And for the younger child, we know that they're going to need to do that for the next 10 years. So essentially, they're going to have a $30,000 outlay for the next 7 years, and then a $15,000 outlay for the 3 years following that. And then the last 10 years before they go to early retirement, they're not going to have that education outlay because they're going to have done such a good job of saving for their kids' education during the first 10 years of their plan. So the next thing they're going to have to do, and after we've crunched some numbers, we know that they're going to have to save and invest $35,000 a year for the next 10 years in order to hit their goal to have a rental property that's going to help provide them some income in early retirement. We're going to assume that they're going to earn 8% annually on that investment to get them a little bit more than the $500,000 that they need to purchase that property. This will hopefully account for most, if not all, of the closing costs that they're going to have when they go to purchase that rental property as well. Finally, we know that after doing all of this, this is going to leave them with about $61,000 in discretionary income left over. This is what we're going to funnel to a brokerage account. And that brokerage account, remember, is going to be the first source of income for them in early retirement. So they're going to have things that are going to pay to them like the rental property income, but this is going to be the bulk of the portfolio that is going to pay them income in early retirement. So having a good, healthy amount like $61,000 that they can invest over the next 20 years is roughly $1.2 million total. That's going to grow to a very healthy amount, probably somewhere in the ballpark of 3 to 4 million. That'll help subsidize an early retirement before they're eligible to tap into their retirement accounts like their 401ks or the backdoor Roth IRAs we're doing. So the nice thing about approaching it this way is when you take into consideration that some of their goals are going to be hit before early retirement, it also gives them an opportunity to redirect excess cash flow along the way within their plan. So we know the first 7 years they're putting $15,000 away for college education for their first child. And then that contribution can stop because they're going to have it fully funded. So they can then go and put that $15,000 into the taxable brokerage account, effectively making that contribution $76,000 a year for the next 3 years until they're able to then stop funding their second child's college education and have their rental property fully paid for because they've done such a good job saving for that. So they're going to have another $50,000 that they could put on top of that. So $126,000 total to redirect into cash flow into the brokerage account, which will do most of that heavy lifting, like we said, in early retirement. Okay, so let's take a look at how this taxable brokerage account is going to grow over the next 20 years. So we know that, years 1 through 7, they're going to put in $61,000 a year. And let's assume that they're going to earn an average rate of return over the 20-year period of 8%. So we know that the $61,000 they're doing years 1 through 7 will grow to somewhere around $1.48 million by retirement. And then we know in years 8 through 10, they're going to have another $15,000 to contribute to this account because their first child, we no longer have to fund their education expense anymore because it's going to be fully funded at that point. So years 8 through 10, they're going to put in $76,000 a year, and that's going to grow to a little bit more than $500,000 by the time they reach retirement. And then for the last 10 years, they're going to have even more money to funnel in, about an extra $50,000 or $126,000 total, because their second child's education will be fully funded and the rental property will have been purchased and they no longer have to set aside savings for it anymore. So the $126,000 that we're contributing in years 11 through 20 is going to grow to about $1.825 million by early retirement. This is going to give them a total balance in their taxable brokerage account of about $3.4 million that they'll be able to use penalty-free within the first 10 years of their retirement. Now, they will pay capital gains taxes on that, and there's no way around that unless we effectively tax loss harvest, which a good financial planner can help you do. But they're essentially going to have roughly $3 million after tax, assuming we're paying capital gains taxes on everything here, to utilize for early retirement. So not a bad way to fund yourself in the beginning years before we can tap into those 401ks and IRAs. So in this example, our retirees, when they retire at age 55 and they're still spending $20,000 a year in retirement, they have more than enough money in their taxable account to cover expenses until they can tap their retirement accounts. But what if we're working with a client who's not so lucky? For whatever reason, they have more expensive goals they need to fund ahead of time, or they just do not have the capacity to save as much money. How should we think about liquidating the accounts in order of preference to, one, fund their early retirement lifestyle, and two, mitigate taxes and penalties that they might pay? So what we should do first is we should still tap their brokerage account. There are no penalties or restrictions on these funds, and it is still the first source. Next, they should utilize their HSAs for any health-related expenses only. These funds are not taxed when used for healthcare, and by covering medical expenses with it, it will allow their brokerage account to not be depleted quite as quickly. The next source of income would be their 401ks, specifically accessing those funds via a 72T distribution, which allows them to bypass the penalty for taking these funds early, but they still will pay taxes on the distributions, but it is a nice way to help spread out that tax burden and not be penalized when funding an early retirement. Finally, they can consider taking their contributions out of their Roth IRA only. We have to make sure that those contributions have been in there for at least 5 years so they can be returned to you. Ideally, this is the last bucket that we'll touch because there are no tax ramifications, but we do want this money to grow as long as possible, because the longer money can stay inside of a Roth and grow, the more tax-free income you're going to have for yourself or for your beneficiaries in retirement or after your passing. So now you know the secret early retirement blueprint. Making sure that you diligently plan your cash flows and how you're allocating those to fund your other goals and then optimally save for your early retirement will take you a long way. If you find yourself still struggling with what to do after watching this video, please follow the link below in the description to schedule time directly on my calendar. We can talk about what your custom blueprint looks like. And don't forget to hit that like button. Thanks again for watching.